Hello and welcome to today's ASX Top 50 video market update for January 2018. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hine, Managing Director of Investor Signals. I have 22 years of experience in the financial services industry and a licensed securities and derivatives advisor. The format for today's presentation, we look at the macro update driving global equities. We roll through the ASX Top 50 with a particular look at FY 18 and FY 19 earnings along with dividend forecasts. We look at our model portfolio holdings and we conclude with a market outlook. Recently, Investor Signals has been finalising the work on our algorithm model portfolio approach, and up on screen is the performance for 2017. So the time-weighted rate of return for the basket of top 50 stocks that the algorithm engine has been managing the buy and sell signals delivered 22.18% return for the year, which was one of the best performing asset classes when you consider that it certainly outperformed the XJO and by a small margin also outperformed the S&P 500. So throughout the course of the year, there was the rate of return shown there, which again delivered 22%. If we look at the December quarter, we mainly had sell signals. So starting at the bottom here, we've taken profit on Macquarie, taken profit on James Hardie, taken profit on Ramsay Healthcare, taken profit on AZJ, taken profit on Woolworths, taken profit on APA, and taken profit on Suncorp and also Centre Group. The only buy that we had in the December quarter was Newcrest, and as I roll through the top 50 stocks, we'll take a look at those in a little more detail. The way the model portfolio service works now is as a subscriber to Investor Signals, you receive an email whenever a stock is either being added or removed from the model portfolio, and you can either choose to place those trades yourself on your CommSec or E-Trade account, or alternatively open a broking account with us and we'll do the matching of the model portfolio for you, and we'll also overlay the covered call strategy where we think it's appropriate. If you're interested in considering being a subscriber to Investor Signals, we offer 3 packages: the investor, the trader, and the professional. The professional version gives signals across the ASX 20, 50, 100, 200, all the ETFs listed on the ASX, as well as the S&P 100 in the US and the NASDAQ 100. But it also includes some services around foreign exchange, world indices, the email service that I showed previously, and also the platform login and API connection service, along with sort of an advisory support where you can speak with our dealing desk and discuss what's going on in the market. What we're offering at the moment is this professional level access at a discounted rate. So for viewers of these ASX 50 recordings, we're providing that subscription at a discounted rate at $1,320 for the year, $1,980. It's only $1,320 for 12-month subscription. And if you'd like to inquire about that, we offer a 30-day free trial, and at the end of the 30 days, you can then sign up at this discounted rate. So to get access to the 30-day trial, either visit the investorsignals.com website, email me, or call our office. Now, moving straight into the top 50 recording, up on screen here is the graph of the XJO. And where we sit at the moment from a global macro standpoint is US S&P 500 earnings have grown at around 9.5% for 2017. And interestingly, we've started to see some top-line revenue growth. In fact, it's been the best top-line revenue growth since 2011. with S&P 500 revenue growing at about 5.5%, 6% for the year. Equities are trading on a very high multiple, I think, from a historical standpoint. We'll look at some of those at an individual level when we go through the top 50 stocks. The Australian markets are slightly more modest PE, trading at around 18, 19 times trailing earnings, and based on forward earnings growth of about 6-7%. That PE ratio comes down to about 16.5, 17 times earnings. When we look at the technical structure here on the XJO, the market continues to make higher highs and higher lows. We had this consolidation period and then the breakout off the back of the tax plan being pushed through in the US. And the real driver here in the Australian market's obviously been the resource sector. So the weak US dollars helped to see these commodities rally, and we'll have a look at those charts as we move through the top 50. So from a macro standpoint, the focus of global markets at the moment is that there's synchronized global growth, with Europe recovering, Japan doing better than it has done for many, many years, China is continuing to deliver sort of 6.5 to 7% GDP growth, starting to see modest pickups in manufacturing data globally, and that's helping to underpin equities, especially in an environment where interest rates are continuing to remain low, albeit there's a little bit of a recalculation going on globally within the bond market as the market starts to reprice interest rates moving slightly higher. So the first step here is we click on watch list, we go in, we select the top 50 watch list. We then go back to the charts and we start moving through the codes. So AGL is the first stock in the top 50 that we look at. And we don't mind this company, albeit we think there's probably not much more than about 8% earnings growth into 2018. Puts a stock on about 15 times earnings on a 4.8% dividend yield. So we own this in the model, but we've been selling covered calls up at around $26. And a combination of the dividend and that call option is bringing in about 10% income. And you can see there that it's under a current algo buy signal. Aristocrat Leisure, this is one of the faster growing stocks on the ASX, delivering about 20% earnings growth over the next 12 months. The stock does trade on a very high PE, about 22 times earnings and a 1.8% dividend yield. Historically, the algorithm signal's done a very good job of flagging these higher low formations, and the most recent signal here at around $19, the stocks continue to sort of trade in a bullish structure, and we're probably got no reason not to believe that this sort of dip's going to get bought up again. Wouldn't be until the stock come down and broke through the low here of, say, $23 that we'd maybe start to reconsider that sort of bullish bias that we have towards Aristocrat. MCOR, we like this name, mindful that the company recently highlighted that the first half earnings were going to be flat on the same time last year, which was a bit of a disappointment to the market. And I think that commentary's helped to sort of cement this downtrend at the moment, albeit that we think that at around this sort of 1460, 1470, Amcor's good value, 17 times earnings, about 4.4% dividend yield, and again, overlay a covered call and drive that cash flow up to around 10%. If you don't own Amcor in your portfolio, keep an eye on it. I think you'll see it present a good buying opportunity over the days ahead. One of the factors that's influencing Amcor is the strong Aussie dollar is a negative to the earnings translation of US dollars. So we think the Aussie dollar tops out soon, which would create a buying opportunity for some of these US dollar earners that are sort of under pressure a bit from a technical perspective at the moment. AMP, we actually like this name, 14 times earnings, 5.7% dividend yield, probably only about 3 to 5% earnings growth. But we're encouraged by the higher low structure here, and AMP sits in the model at the moment. ANZ, one of the three out of the four major banks. CBA is not in the model, ANZ is, but we're not expecting too much growth out of the banks over the course of this year. APA Group, I mentioned at the beginning of the recording that this was one of the stocks that we sold. So the algorithm signal flags or the lower high structure there, and we got out of APA, and the stock's fallen from 940 down to 810. So that was a well-timed algorithm signal there. ASX, about 3% earnings growth, 24 times earnings, 3.7% dividend yield. This stock's really being treated as almost as a bond proxy, in that the earnings are seen as defensive, the yield's compressed. Historically, for ASX to be trading 24 times earnings, that's a very high multiple for a stock that's traditionally traded around 14, 15 times earnings. But at the moment, the volume, revenue, bottom line numbers all seem to be meeting their targets, albeit at very low levels of growth, between that 1 to 3%. Growth. So ASX, we like the company. We still think there's the potential of a takeover offer at some point, but we'd like to buy into it at lower levels. The most recent algo signal was a buy there at around $48. Horizon, this is a stock that is not in the model. It was one of the ones I covered at the beginning of the recording, where we'd had a sell signal on it. So we'd bought it down here at around 425, and we sold out of it around this 550 level, and the stock's since sold off. BHP, so these commodities have been very strong off the back of better oil prices, better metal prices, and partly being driven by a weaker US dollar. And obviously that synchronized global growth theme has seen money come into these commodity names. The algorithm engine triggered a buy signal at around this $22, $23 level, and BHP still remains in the model. Brambles, currently at the moment, it's under an algorithm sell signal, so it's not in the model portfolio, but at around 19 times earnings, 3% dividend yield, there is an opportunity to own Brambles at this level and sell, say, a 10.50 call and strip out the February dividend and collect good option premium for that 10.50 call. CBA, we're not doing anything here. Out of the four banks, this is the one that is not in a buy signal, and what it's flagging there is this bearish price structure. So it wouldn't be until CBA really traded back up above $85 that we'd start to get serious about thinking about the downtrend ending. But in real terms, CBA was $96 2 years ago. It's now $80. It's $16 off its highs. And I think from a technical standpoint, it's likely to run into resistance at or near this price point at the moment. Computershare, the stock's very expensive, 20 times earnings. We think that this could be a real compelling short opportunity in the market, but it certainly doesn't sit in the model at the moment. CSL does, so this is a core holding in the model. It's been one of the best performing stocks. It is expensive at the moment, 31 times earnings. CSL should grow earnings at around 15 to 18%, so it's certainly one of the faster growth stocks over the next 12 months. Buying it here and selling, say, the 150 or 152 covered calls turns CSL into a high yielding stock. We don't think the stock trades too much above that 150, 152. So it's a way of shareholders of CSL driving extra cash flow. KTEC, so we own this in the model, but we think it's getting a little expensive up here just from a yield perspective. I think there at the moment, albeit recognise the stock is in the model. Fortescue, so this Fortescue was the worst performing stock in the model portfolio, and we're starting to see a fairly sharp recovery in the performance of Fortescue, and I'll have a look at that when we summarise the current holdings in the model portfolio. But with iron ore prices improving, obviously all these commodity stocks are doing well at the moment. Goodman Group, so one of the biggest shifts in the market over the last week or two has been the capitulation in yield-sensitive names. So property trusts, infrastructure names have all sold off. as US interest rates have started to move, or the yield on US interest rates has started to move higher. And the flip side of that is these yield-sensitive names have endured selling pressure. The algorithm engine's just starting to flag that there's a higher low formation now in place, and that may actually provide a good entry opportunity. And Goodman Group's been flagged in the algo engine as a buy. So it's 17 times earnings and a 3.4% dividend yield. It stays in the model portfolio, as does GPT, about 15 times earnings on a 5% dividend yield. So we own this, and we've sold covered calls up at around $5.50 to enhance the return there. Insurance Australia Group continue to like this name, 18 times earnings, 4.5% dividend yield, but we think it needs to be complemented with a covered call. We don't see too much upside short term. The most recent algo buy signal was back here at 573, and the stock continues to sit in the model portfolio. Incitec Pivot, we had a buyback here at around 325, continuing to make higher highs and higher lows. The recent sell-off here was the awareness that IPL had lost the explosives contract with Gina Reinhart's iron ore mine over in West Australia. Look, I'd suspect that Incitec will recover from that, given sort of this broader backdrop of strength in commodity prices. So we wouldn't expect the sell-off to go too much deeper than what it's done there. James Hardie, we think this stock's expensive at 26 times earnings and a 2.5% dividend yield. It's under an algorithm sell signals, and we're expecting it to sort of roll over and struggle a bit at the prices trading at the moment. Lendlease is in the model, 12 times earnings, 4.5% dividend yield, should grow earnings about 8 to 10% over the next 12 months, and it's currently in the model under an algo buy signal. As is Mirvac, we can see here the bullish structure of higher highs and higher lows, and the algo engines recently flagged this sell-off and the build-up of volume here on the lows, so at around 220, suggesting that that's an okay entry point. Medibank Private, so this is a name that we like. We think at 20 times earnings and just under a 4% dividend yield, buying it here and selling covered calls is a good way to get access to the upcoming dividend, the franking credits, and drive that extra cash flow from the call options. We think Medibank mainly trades sideways where it is at the moment. Macquarie Group, this has been removed from the model, so we did own it at lower levels, and then we had the algo sell signal. The stock's pushed on a little bit since then. Macquarie trades about 14 times earnings on just under a 5% dividend yield, and growing earnings at around that 8% per annum. But we'll watch this with interest just to see whether we get a further rollover in price action, or whether we get a subsequent sort of algo buy signal over the next sort of 3 to 6 months in Macquarie. National Australia Bank algo buy signal here at $29, but largely trading sideways for the last 6 months or so. So we're not expecting any major change there on the domestic banks. Newcrest, this was the only stock that was added to the model portfolio in the December quarter. We had the algo buy signal down here at around 21.70, and the stock's now trading 23.65, and we expect Newcrest to continue to push higher. Interesting that in the December quarter, on a net basis, we had more sells than we had buys. As you've seen, as I've toggled through the charts, the sells have been very accurate, and the addition of Newcrest to the portfolio is now performing very well also. Newcrest, so under algo buy signals, continuing to make higher highs, but probably just getting a little bit expensive at $9.50. Orica, last algo buy signal at around $17. The stock came down, retested that support, and now pushing a little bit higher. We have Orica on about 18 times earnings, about a 2.85% dividend yield, and they should grow forward earnings around 10 to 12%. Oil Search, we're not doing there at the moment. Qantas is under the algo buy conditions at the moment, and we're bouncing off this sort of 475 support level at the moment. So Qantas sits in the model. QBE doesn't, so we can see here the bearish structure of the lower lows, lower highs, and it's rolled over below that sort of recent 11.30 level. So it's not until the stock really started to break back above and make higher highs and higher lows that we'd become interested in QBE. Ramsay, we don't mind this name, albeit recognising that from a technical standpoint, it's struggling a little under this $70 resistance level. We can see the algo sell signal, so it's not part of the model at the moment. Rio is, so we had the algo buy signals down here at around $57, and the stock continues to push higher. South 32 buy signal here at around 240, and South 32 continues higher. Centre Group, so this was one of the sell signals we had in the December quarter, and that was at around 450. So after owning it at lower levels down here at around $4, we'd held it for a while, collected the dividends, but the algo engine's flagging that the lower high structure, it's time to get out. Stockland, so we've had the buy signal here on the recent sell-off at around this $4.30 level. If we go to the short-term indicators, we can see that they haven't yet really turned positive, so we're just keeping an eye on Stocklands at the moment. Sonic Healthcare, this has been one of our sort of favourite stocks at 20 times earnings, 3.5% yield. They should grow earnings about 9 to 10%. We think the stock is a good income contributor to portfolio, owning it at these levels, selling covered calls and generating that 10 to 12% cash flow. The most recent algo buy signal occurred down here at around $21. Santos, not doing there at present. Suncorp, that was removed from the model. So after owning it at lower levels, again, that lower high structure, it's flagged, and the stock's rolled over from $14.50, given up $1, now trading $13.51. Sydney Airports, these yield-sensitive names, so it's currently in the model after a buy signal being generated around 670. That support's being tested at the moment. We think that this correction in these yield-sensitive names is probably pretty close to running its course, and they're getting very close to creating a buy opportunity that investors need to keep a close eye on. And we're seeing that again in Transurban, where previously the algo buy signals at around this $11 level performed very well. The stock's pulling back to test that support. We've had a new algo buy signal. So I think somewhere around this sort of 1150 to 1170 level, I'd expect Transurban to find support and provide a good entry opportunity. Telstra, trading around 12 times earnings on a 5.9% dividend yield. We recognise that the stock's in a lower low, lower high pattern. We had a recent algo sell signal at 370. And we're very tempted to continue to build on our Telstra exposure, but really preference waiting for that sort of bullish higher low structure or the algo buy signal to confirm the entry opportunity there. Treasury Wines, this pullback's generating another algo buy signal. The signals have performed very well in the past on Treasury. Again, this is one of the faster growth stocks, trading on a high PE, about 31 times earnings on a 2% dividend yield, but they should grow earnings at around 20 to 25%. The distribution of the wine products into China continues to deliver substantial growth in earnings for the company. So we'd expect to see that reinforced in the upcoming earnings result. But from a technical standpoint, again, keep an eye on these shorter term signal or momentum. As that starts to turn positive, I think it'll provide a good buy on the dip opportunity there for Treasury. Vicinity, not doing there. We had the algo sell signal at just under $3, and the stocks continued to move lower. Westpac, we have a buy signal at around this 31 level, but as the case with ANZ and NAB, we're really seeing the domestic banks move sideways, and that's reinforced by the CEOs coming out and identifying that it's a very tough environment for them to grow revenue. Therefore, any profit growth is likely to come from cost cutting rather than top line revenue growth. Wesfarmers, 17 times earnings, 5% dividend yield. It spent the most part of the last 4 years trading sideways between a range of roughly $40 and $45. It's back up near the top end of that resistance. So now's the time to sell covered calls over Wesfarmers turn that 5% dividend yield into 10 or 12% cash flow through selling sort of 45 or 45.50 covered calls over it. Westfield, we think that this is a potential buy opportunity ahead of the shareholder vote on the merger in the next 3 to 4 months. At the moment, with the Aussie dollar moving higher and part of the takeover proceeds being in US dollars, it's trading below the takeover offer of $10. But we think as it gets closer to that takeover, we'll start to see a little more value start to emerge. So whilst it's not in an algorithm buy signal from a pure discretionary sort of fundamental play, we think that there could be an opportunity there to look at Westfield. Woolworths, so we owned it at lower levels. We had the algo sell signal. My base case for Woolworths is a company will grow earnings about 8 to 10%, which is relatively strong. They do trade on a high PE, 21 times earnings on about a 3.4% yield. So if you are going to own it here, I think it's an opportunity to sell covered calls over it. But from a pure technical standpoint, it's actually no longer in the model portfolio after originally being added back in September 2016 there at $22, and then it was removed recently at around say $26.30 thereabouts, $26.50, and the stock's pushed a little bit higher since then, but we're expecting it to mainly trade sideways. Woodside Petroleum, so this has been one of the better performing stocks within the model as oil and gas prices have staged a strong recovery, and at the moment there's no sell signal there on Woodside, and there we are back to the index. Okay, so let's just have a quick look at what stocks are in the model. And so we come in here, we click on model portfolio, we go down to ASX 50, and let's have a look at these a couple of different ways. So days held, we can see that Stockland's been added and it's only been in the portfolio for 5 days. Prior to that, Newcrest was in the portfolio and it's been there for 33 days. It's up 6.97%. And then as you sort of go through, so the other way, so that's arranging it by days held. Let's have a look by percent gain. So the best performing stock in the model still is Aristocrat, Treasury, CSL, Origin, Rio, BHP, IAG, NAB still doing well, Medibank is, ASX, Goodman Group, Sonic, Wesfarmers, Woodside Petroleum. If we have a look at which stocks are underperforming in the model, Fortescue remains the worst performing stock by a significant margin, but that is starting to recover at the moment. The other stocks are really only down a small margin. So Westpac, Sydney, MCOR, AGL, Stocklands, ANZ and Lendlease. But by comparison, when we look at the stocks that are performing well, the better performing stocks obviously far outweigh those that are underperforming. And it's that model portfolio. So currently out of, I think, 50 stocks, there's 32 companies that are in the model. And I'm just going to jump back and remind you of the performance. So when we look at the model portfolio, these stocks here, as a subscriber, you get emailed when we add or remove any stock to this model. And if you wish to execute those orders yourself, you can do. And here's the performance of that portfolio over the last 12 months, so 22.18% return. So it's delivered a very good result relative to the XJO. So if you'd like to sign up for the 30-day free trial, all you need to do is go to investorsignals.com, and up on the top of the website, just click on the free trial. I'm just loading that up now so you can take a look. Click on the free trial button there and type in your email address, and you'll be able to log in and get access to the charts and algo and the model portfolio that I've just been talking about today. Thank you for listening in, and good luck with your investing, and look forward to seeing you on board as a trial subscriber to take advantage of the discounted price that we've got on offer at the moment. Thank you.